Welcome to Cyber Stock Reports. Today, we decode the mystery behind the beauty brand that's on every investor's lips, E.L.F. Beauty. That's ticker E.L.F. As shown on the first slide, our analysis is fresh as of December 9th, 2025. And what we've found is a really fascinating tug of war between incredible growth and some pretty serious red flags.
Now, before we really jump in, just a quick but super important reminder, as you see on the screen, this is an AI-powered simulation. It is not financial advice. We're here to break down the data, but you should always invest at your own risk. Okay, let's get right into it. The whole debate, the entire conversation around E.L.F. right now, it really boils down to one simple but absolutely critical question. Is this recent pop in the stock price a real recovery, or is it just a dead cat bounce?
And here is where the plot really thickens. On one hand, you've got a solid 6.2% rally. That's a clear bull signal, right? But on the other hand, the stock is trading at a sky-high 55 times forward earnings. That's a massive bear signal. This exact conflict is why E.L.F. has become what we call a battleground stock.
So, to make sense of all this, here's our game plan. First, we'll break down what this beauty battleground really is. Then, we'll explore the bull case and follow that up with the bear case. After that, we'll add some crucial context before we wrap it all up with our final verdict.
All right, Section 1, a beauty battleground. When we say battleground stock, what we really mean is that the market is just completely split. You have these two groups of investors with totally opposite beliefs, and that creates a ton of volatility and a lot of uncertainty. And right at the heart of the bearish argument is this thing called the dead cat bounce. It's basically a fake out, a short-lived price recovery in a stock that's actually still headed downwards. The million-dollar question for E.L.F. is this rally real, or is it just the cat bouncing?
Now, let's flip the coin and look at the other side in Section 2, the bull case. The whole argument here is that the market is just getting it wrong, that it's overreacting and totally misunderstanding the company's real potential.
So the bulls, they're feeling pretty confident, and they're standing on four main pillars. First, they think all this panic about tariffs is way overblown. Second, they're pointing to a huge potential growth catalyst. Third, the company has proven it can raise prices. And finally, there's a weird regulatory shift that's actually helping E.L.F. out. And this number right here, $200 million, this is what has the bulls so excited. That's the projected annual run rate for their newly acquired brand, Rhode. Look, if they hit that number, it isn't just a little boost, it's a total game changer that could completely reignite the company's growth. And this is that weird advantage I mentioned. E.L.F. has this unexpected regulatory moat protecting it. See? A government crackdown on cheap direct-from-China shipments is building a kind of seawall. It really hurts competitors like Shein and Temu, but it makes E.L.F.'s position in the U.S. market even stronger. It's a totally counterintuitive edge. But hey, every battle has two sides, so now we turn to Section 3, the bear case. From this point of view, that recent rally isn't a good sign. It's a trap, luring unsuspecting investors into a really dangerous situation. The bears are pointing to four pillars of their own that look like they're crumbling. They see the fundamentals getting worse, a trust gap made wider by insiders selling their own stock, inventory levels that are spiking, and a valuation that just seems completely disconnected from reality. Okay, this number should definitely make you pause. While the top-line numbers look good, once you adjust for things like inflation and what's called channel stuffing, that's basically pushing more product into stores than people are actually buying, our model suggests that real revenue might have actually gone down by 3%. That is a massive red flag. It hints that real demand could be weakening. And what's making things worse is this growing trust gap. That short report from Muddy Waters, with its accusations of inflated revenue, well, that shadow is still hanging over the company. And then you see company insiders selling off their own stock pretty aggressively during this rally. It makes you wonder, right? What do they know that the rest of us don't? Okay, for Section 4, let's zoom out a bit and put all this into context. It's great that E.L.F. is beating its competitors, but we also have to weigh that relative strength against the absolute risks that could, sink the whole ship. I mean, in the beauty world right now, E.L.F. is basically the champ. While these old school giants like Coty, that's C-O-T-Y, and Estee Lauder, E.L., are really struggling, E.L.F. is just eating up market share. The relative strength, it's undeniable. But history gives us a pretty chilling warning here. Under Armour back in 2016.
The parallels are kind of scary. You had explosive growth, then slowing sales, and then a huge mountain of inventory that nobody wanted. For E.L.F. to avoid that same fate, the Rhode Grand can't just be a success. It has to be a grand slam.
So this all comes down to a concept called asymmetric risk. And put simply, it just means a situation where the potential losses are way bigger than the potential gains. And when you look at E.L.F. right now, that risk profile is starting to look dangerously lopsided. So, what's the bottom line? After weighing all of this, let's bring it all together in our final section, the final verdict.
E.L.F. is really standing at a crossroads with two completely different futures ahead of it. In one future, the Rhode brand is a massive hit. Tariffs don't matter and the stock soars. In the other, the tariffs hit hard. That high valuation crumbles and investors head for the exits. This is what asymmetric risk looks like in the wild.
So where do we land on this? In the short term, our bias has to be neutral to bearish. The stock is simply priced for perfection in a world that is anything but perfect. With that 55x valuation and the storm clouds of tariffs on the horizon, there's just no room for error. None.
And that leaves us with one last big question. We've seen what happens to other high-flying stocks that showed these same warning signs. So, is the Rhode brand catalyst really powerful enough for E.L.F. Beauty to defy history and write a different ending? Finally, please remember this is an AI simulation. The final investment decision is yours and yours alone. Thanks for joining us at Cyber Stock Reports.